Imagine a 78-year-old retiree who did everything by the book. For 15 years, every month without fail, he paid a $475 life insurance premium. Then a letter arrives in the mail. His premium is jumping to $2,200 a month. That is over $26,000 for just one more year of coverage. The price increased simply because he got older. Staring at that number, he feels a sense of obligation. He whispers to himself, "I can't stop now. I've already paid for 15 years." This specific insurance dilemma represents a trap that forces people to spend thousands of dollars on products they no longer need. Using past spending to justify a current bill is a logic that can drain a retiree's savings faster than almost any other psychological error. The confusion starts with a misunderstanding of how the product actually works. It feels like those 15 years of premiums were accumulating in a vault, building up equity for the future. In reality, term life insurance doesn't build cash value. Each payment buys a 30-day window of protection. When the month ends, value resets to zero. Reaching the end of a 15-year term means you survived. It worked exactly as intended. Because no equity was ever built, continuing to pay a radically increased price based purely on the history of the policy is a mathematical error. If the math is clear, why does the human brain fight so hard against walking away? This is the sunk cost fallacy. Evolution has hardwired our brains to despise the feeling of wasting resources. Whether it's time, effort, or money, we hate admitting an investment is gone and unrecoverable. We see this when people sit through a boring movie because they bought the ticket, or when someone pours thousands into a failing car because they just replaced the transmission. The $26,000 insurance dilemma is that same cognitive glitch, applied to a bill that costs as much as a new car every single year. Letting unrecoverable past funds dictate your present choices creates a cycle where you keep losing money just because you lost it yesterday. Breaking this cycle requires a mental reset. You have to evaluate the situation using a zero-based method, wiping the slate completely clean of any past payments. Ask yourself one question. If today was day one and someone offered me this exact coverage for $26,000, would I buy it? If the answer is no, you can focus on the practical questions. Does a spouse still rely on your income? Can this policy be converted into a different type of insurance that costs less? Insurance regulators recommend that policyholders investigate their conversion rights and future renewal limits before accepting a price hike. Walking away from an expensive policy isn't a failure. It is an act of financial self-defense. Every dollar you spent in the past is gone, and your future savings should not be held hostage by your past spending.